really shouldn't be trading right now.
Frank, you're trading? We're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh,
We got the mobile version now, remember that?
oh that's right. It's Finder
Yeah,
Mobile.
yeah.
Yeah. Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, everybody. Welcome back. I like this intro song a lot. Hope everybody's doing well. New day, new moves happening. Actually, not any new moves happening. The same ones happening. NASDAQ leading the way. Dollar kind of staying sideways. Gold's up. We like to see that. Silver's up. I'm long silver and gold, so always a nice day when the metals are a little higher. Yields also up. Not so fun, but barely up. I mean, we're flat. Today we have a lot of stuff happening. We actually have Jerome Powell speaking. Also, really quick, if I can go full camera mode for a second, guys, I could show you my the layout here a little bit. We changed a couple things here in the room. Ignore the paneling on the side; it looks awful. We'll keep it like that. There we go. Good to see everybody. Thanks for coming back. Yeah, there's the new setup. I like it. The only thing is I want to move the trading view sign here a little bit more this way. But other than that, I think it'll be a good setup. We'll take that. We spent some time yesterday just rearranging the room, and we do that like it's like a quarterly thing around here. Anyways, we'll go back to taking a look at some charts here for a moment. And again, we've got gold and silver up a little bit today. The stock market is just slightly higher, and we are continuing the grind fest. The grind higher does not want to quit, it seems. Here's a look at my current positions. Long XLK still, gold, silver, TLT. I have not changed my positioning. I have not done anything to my trades. And I was looking at my USD CHF short, though. Swiss franc short may be giving us a chance to look for a trailing stop opportunity. So the way I like to trail stops is I'm looking for, so we caught this move here. It sold lower. That was great. But this pullback here is now what I'm watching close. If we can get something like this, okay, we can call this a lower high. Now, a lot of traders, I think on a simple technical analysis basis, they get this idea wrong. What they say, they do here, they like look at this and they say, well, look, that's a lower high right there. But we don't know if it's a lower high, right? What if this rounds off and the lower high is right here, right? How do you know if a lower high is a lower high? Well, you wait for, in my simple technical approach, a break of structure and a new low. So a lower low then confirms a lower high, at which point I can take my stop loss and nicely tuck it behind that lower high. That's how I would manage this trade. So I have a short position open. I'm bearish on the dollar at this time. And we'll see where that goes. Let's take a look at the dollar yen. The dollar yen has continued to be just a thorn in the side if you are a bear, because this has been tough. I've not touched any short ideas on the yen or the dollar against the yen for some time. I think it's a tough one to try and time. I think really, sorry guys, I'm just pulling up the live stream schedule, make sure I have it in front of me here today. Okay, so today we are going 9:20 until 9:45. We got James joining at 9:45. We got Powell speaking today at I believe it's 10 a.m. So 10 a.m. we'll hear from Powell. I imagine that that's going to be an interesting time in the markets to see what he has to say. So we'll be, by the way, if you're wondering what I'm looking at the A1 Trading live stream schedule. You can find this on our website. So if you're a regular stream fan, first of all, help us out. Do us a favor here and hit the thumbs up button on the stream if you're enjoying it, if it's helping you out. Of all our different guests we've got today coming on, we got James and Chris, which will be great. So you can always find the schedule on our website, a1trading.com/livestream-schedule. Okay, so let's see where we're at. So the dollar index is a place I'd like to keep an eye on. So yesterday we had a conversation. James and I actually had a conversation about this trend line here. So the dollar index has come down and kind of broken out of this level here, this level of support. But the next level is to see if we can actually break this trend line and see some follow through to the downside. The big level that I've been watching for like a couple months now is this 104 level. So 104, if that level breaks, something I would say, if you see this level break, what has probably happened is rate cuts are very much coming, right? If you see, I personally think that rate cuts we're going to get a rate cut or two this year. If that is what we've got coming down the pipeline, which I think it is, I think the dollar index will make its way down to 104. We'll see if I'm right about that. I could be wrong. We could see a really hot inflation report this week and boom, there goes the dollar back higher. But I think we've got a lot of data recently that would suggest that the U.S. economy is starting to show signs of slowdown, some cooling in the U.S. economy. I've talked about this data over and over, but just to reiterate, we had services PMI. This was really concerning in terms of people who are looking for like a extreme acceleration of the U.S. economy. Services PMI was kind of what people were holding on to. I listened to a lot of different, people who speak about markets. Obviously, it's like my job to talk about them, but I also listen to a lot of others. And the economy bulls, the people who think the dollars are going to stay really strong, they did not like this number. And I'm not saying I think the economy is going to crash, but I think that the economy is going to cool. I think it's showing signs of cooling, and as long as that trend persists, I'm more bearish on the dollar. And so when you talk about, you could get into sector conversations about this. You could say industrials to me look less attractive because, again, I think that the economy is showing signs of cooling with this services PMI data. This is showing us that the services component of the U.S. economy, which is the biggest part of our economy, services, right? Software, internet businesses, if they are showing some more slowing outlook, that would suggest that the economy is likely to continue to cool, that labor will continue to cool. So maybe you see unemployment continue to trend up. And if that is now a persistent theme, it's a matter of time before the Fed says, okay, we have a dual mandate here, right? J and I, the dual mandate of the Fed is that they want jobs to stay strong and inflation to stay stable. Inflation is Well, we're going to get some information about inflation this week, aren't we? We're going to get CPI and PPI. But jobs data is definitely showing signs of slowing. So this slowing suggests that rate cuts, probabilities for rate cuts are increasing. This will likely come down in this scenario. So it's almost like this week is just, can we get some proof? Can we get some progress on inflation? If inflation starts to come down, rate cuts, we probably have the all clear for rate cuts in September. So we'll see. Inflation is really, really important this week. That is why, we've seen the jobs data. The proof is here. Jobs data is showing signs of slowing, right? Unemployment claims are rising. Job openings deteriorating or slowing, right? Unemployment rate is trending higher. So you look at this and you say, okay, we've got jobs data slowing. Is that going to start to impact the inflation story? And if so, rate cuts are probably appropriate this year. Does that make sense? Do me a big favor. If that breakdown helped in any way, shape, or form, hit the thumbs up button on the stream and help us out. Can I get, hold on. Where's my sound? My sound is broken. Oh no. I don't know why my soundboard stopped working. Can you guys hear my soundboard? Maybe I just can't hear it. Could you guys just hear my soundboard? Maybe my speaker just shut off or something. Anyways, nope, you guys couldn't hear it. Okay. Weird. I think my Stream Deck just froze because now nothing is moving on it. That's just sad. That is just sad when the Stream Deck is down. It just is a vibe killer. Anyways, let's take a look at some more charts here. Just pretend I made a cool soundboard effect there, and we'll push on. Okay, so let's talk gold here for a second. So if we're going to see the economy slow, and that to trigger rising unemployment and that to trigger inflation cooling, good shot that I think we see rate cuts. If rate cuts are on the menu, I like gold. And rate cuts are not just on the menu for the US. Rate cuts are happening in other places. Now, one person in my comment section made a really good point. They made a really good point. They said, look, the ECB cut rates, the Bank of Canada cut rates, and look what happened. Inflation the next time around came in higher. So is there a warning sign here that if we cut rates too soon, we're going to see inflation skyrocket? We could have inflation problems round 2 if we cut interest rates too soon. Yes, that's the hard part here, is that the Fed has like an impossible to do job right now. Inflation is still kind of high if you take a look at an inflation level. Now, I know a lot of traders want me to look at a lot of charts, but trust me when I say, like, this, in my opinion, in my approach, is the last part. The technical charts, the candlestick patterns that people spend all their time looking at are certainly still important, trust me, but just bear with me when I go through a lot of these data charts. This is the stuff that brings clarity to the movements that you're happening in the candlestick charts. I talk fundamentals a lot because I believe fundamentals lead price action. It's more valuable to understand the fundamental story, in my opinion, because then you can get an interpretation of what is likely coming down the story pipeline. It's like if you're reading a good book, you have a pretty good idea of what could come next. Sure, there's twists and turns in a good story, but generally speaking, you can kind of infer what's going to happen in the next chapter if you're a good reader. That's the same concept with good fundamental analysis, taking a look at the macro story. So right now with inflation data, you've got CPI still sideways. Should they cut rates? It's a debate. If you get inflation starting to cool, maybe they should, because now you're seeing labor data cool and inflation cool. Maybe that's a good sign. But what if inflation is flat? Are they still going to cut rates? Well, only if the economy sees jobs data really slow. So we'll see. I mean, it's a tricky spot for the Fed. I'm not going to lie. That being said, in either scenario, I stay convicted bullish on gold, because if we get both of these scenarios to me sound like a decent spot to be long gold. And again, I'm not telling you what you should do. You absolutely should not listen to me. You should, if you're looking for investment advice, go talk to somebody, speak to a financial advisor. I'm not here to do your homework. I'm doing my own homework. I'm sharing my own opinions, my own ideas, and what I'm doing with my own personal funds. I say that because a lot of times new traders are like, what should I buy? What's going to happen when Jerome Powell speak? And, what's CPI going to do? And I'm not a fortune teller. I'm just a trader, right? Traders operate off of probabilities. I'm not always right. So I like gold to the upside because if we see the labor data continue to come in cool, if that accelerates to the downside, that's a bull case for gold in my view, because it would suggest that the Fed might turn the printers back on, printing a lot of money, printing a lot of fiat currency, typically bullish for gold. Side note, is that bullish for Bitcoin? I would say no. My opinion, I could be wrong about this, but Bitcoin is far too correlated. At least its track record has been very correlated in recent years to what's happening with high risk stocks. High risk stocks like ARK Invest. There's a lot of correlation between high risk, unprofitable tech companies and Bitcoin. Not always, but enough to say that, if the economy crashes, I don't necessarily think that Bitcoin becomes a safe haven. I'd much prefer gold. And that is why, why am I not all in on Bitcoin? Well, it's because I like the track record of gold. Gold, if the Fed is going to start turning on a printer like crazy, in higher inflation environments, gold typically has stronger performing years, especially if the Fed is cutting interest rates and is not, the economy is teetering. A teetering economy plus a lot of printing of money, that is, a candidate for gold bullishness. It's why I like it long. It's why I've been long pretty much all year long. I've been trading in and out of it, but I caught a lot of this move, I took some losses during these previous couple months, but I've got a nice trade going right now. So please understand, I'm not always right about gold, and I've taken plenty of losses in recent months. But the recent trades that I've had have been a lot better, and we'll see if we can catch a bigger move higher. I think that gold has a potential to reach the highs and break them this year. So if I'm right, I'll make money and I'll trail stops on it. And if I'm wrong, I do have my stop loss trailed. So I won't lose money on this trade, but obviously I would prefer it to keep going higher. But if it doesn't, then it doesn't. And I'll look for a better chance to re-enter. So that's something to think about. Silver, I also have a position long, and this one is actually looking a little cleaner than gold, to be honest. I have bullish readings on both of these on the EDGEFINDER's top setups page. Check this out. We've got bullish setups on silver, bullish setups on gold. TLT, I'm still long on that one. And I have a technology position. We'll call it NASDAQ. It's very similar, XLK. So I have a couple trades open. I haven't changed anything. I am more of a swing trader. So you guys hear me talking about ideas, I'm not usually like in and out the same morning or the same day. I'm usually, holding on to positions and trying to let them work for me. So technology has been just a killer this year. It's just been a monster mover. And every time I think I'm going to get trailed out, or every time I think it's going to reverse, it just keeps going higher. And it doesn't mean that it will go on forever. It certainly will not. There will be a point where you say, where nobody wants to touch technology, like in 2022. Like look at 2022, right? Terrible year for tech. So I'm keen to the idea that I'm not going to stay in this trade forever. I'm not going to, get caught up in the hype. I'm just going to trail stops. In fact, I probably need to trail a stop again now that we've broken through these previous highs. Taking a look at the NASDAQ, you can see it's a very similar chart to this. So if I switch over to NAS 100, you can see it looks very, very similar. That's because the technology component of the NASDAQ is very heavy. So XLK is it's a technology, a basket of technology stocks. So anyways, I'm watching tech, I'm watching gold, silver, and I'm watching TLT, which TLT, man, I've just been battling with this trade for months. I've been down a lot on this trade. I've been up a lot on this trade. It's just gone back and forth. This is more of a position trade for me. This is not something I'm trading like based off of momentum, because admittedly, momentum has not been very good for TLT. This is not my traditional kind of momentum trailing stops approach. This is more of just I want to dedicate a component of my account to TLT. In the instance that we get rate cuts this year, I like TLT. And also TLT is a bit of a hedge in the event that it wasn't a good hedge in 2022, but in the event that we see inflation come down and the economy slow, TLT would look really, really good. Now, if inflation cools and the economy stays strong, TLT will look okay, and TLT will look terrible if inflation accelerates again and the economy stays strong. It just won't look very attractive. So, because in that case, you would see yields continue to trend higher. So here's a look at the yields market for this today. Also, I just did a bunch of stuff with the EDGEFINDER. If you guys would like to try it for 30 days, check it out. We've got the link being dropped in the chat for you. You get 30 days access to the EDGEFINDER. If you are someone looking to implement fundamental analysis using macroeconomic data in your charting, I highly, highly recommend it. Fundamentals have been a game changer for me, and I'm not just saying that. I show you guys my trading account, my live logins and stuff like that on a regular basis. Fundamentals changed everything, right? Everybody looks at technical charts. Not many people look at fundamentals except for hedge fund managers and institutional money. They all talk fundamentals. If you ever listen to an interview with Ray Dalio, is he talking about Head and Shoulders? Heck no, he's not talking about Head and Shoulders. He's talking about real data. He's looking at the consumer data. He's looking at what banks are, showing with depositors or the lack of deposits coming from. They're looking at savings from the positions in banks. They're looking at, this is what institutional money looks at. They look at the real leading indicators that macroeconomic data can show you. It's very powerful stuff. So if you're wondering about how to get involved with fundamental analysis, we've built a tool. This is what I use day in, day out. If you'd like to try it for 30 days, you can apply using the link being dropped here in the chat. Click this link, take a second to apply. Let us know what you're looking for in a tool like this, and we will reach out to you with the 30-day trial information. So if that is something you're looking for, I'm telling you, take us up on that. Check it out if you're serious about this stuff. If you want to learn about, the consumer, the state of the consumer, are people spending money? Are they not spending money? How are jobs data looking? Like, all of this stuff is super, super valuable. I cannot vouch for it enough. It's been such a game changer for me personally and for many other traders using the tool. Take the trial, 30 days. Again, click the link. There it is. Okay, so in terms of what's on the news today, we do have Jerome Powell speaking, I believe, we've got, what is he? He's on Congress, right? He's, in Washington, D.C. Before Senate Banking Committee. Oh, that could be drama. Testimony usually comes in two parts. First, he reads a prepared statement. Then the committee will hold a question and answer session. Since the questions are not known beforehand, they can make for some unscripted moments that lead to heavy market volatility. Well said, Forex Factory. That is exactly right. Whenever there's unprepared commentary from Jerome Powell, questions that come his way and how he answers them, certainly can cause volatility. A little bit of uncertainty going into this. Gold is up just slightly on the hourly chart. The 4-hour chart is green. S&P 500 near all-time highs. Same thing with the NASDAQ. And the Dow Jones continues to be the laggard of the group. Last thing I will say is I've talked about this rotation trade for a long time, but I haven't actually made any movements on the rotation trade idea. What I mean by that is buying the laggers of the stock market, right? Like other sectors other than technology. I'm only long technology right now. It's because the only one that I can see a really strong case for. I'm not buying consumer discretionary, even though it has been strong recently. I'm not buying healthcare or financials. Like, I just don't quite see it yet because, there's some mixed sentiment. Anyways, guys, we're going to now bring in Forex James. It is his turn to come in, talk a little bit of markets with us. So after this quick break, we'll be joined with Forex James. You guys know him and love him. He's been a regular contributor to the A1 Trading Show, and he'll be on right after this.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show.
All
Hey.
right, and we are back with James. What's going on, man?
Yeah, good. Thank you. How are you?
I'm good. Good to have you back on. We spoke yesterday. It was kind of eye-opening just talking about the dollar. We actually took a clip of that and put it in my video yesterday, just talking about this dollar trend line. I'm curious, any updates since yesterday in terms of your USD outlook?
Not fundamentally. There is the support you've got drawn. Well, I guess it's resistance now, where price is just at like current market price. To me, it looks a bit like a break and retest. So it's kind, I'm a quite a big lover of a break and retest when looking at trends.
Yeah.
So to me, I've got a bearish bias on the dollar at the moment. So I'm kind of looking for that at the moment, just a continuation of this move to the downside. We've had the EMAs cross as well. This is the 50 and 200. So yeah, we did see a bounce off this trend line. So it's going to be interesting to see if it can sustain prices above, or if it does finally have that break below. But yeah, I've got some open positions. I think we spoke yesterday actually about the USD CHF. So I executed that actually not too long after our stream.
Oh, nice.
So yeah, it was a bit of a premature entry, quite aggressive, but it's coming back down to entry now after some drawdown. But yeah, looking for lower prices on the dollar overall.
Okay, cool. And also, I think you were long silver, right?
Yeah. This is our long silver position. It's currently break even, so it's very similar to your gold trade, I think. But yeah,
Yep, I've got silver and gold, so that's cool that you've got kind of a similar outlook on that.
Yeah,
silver up almost 1% today.
Yeah, no, it's doing really well.
Yeah, so silver and gold. I'm curious, with the dollar, there's also just so many catalysts, or I like to say shots on goal, like potential things that could drive gold and silver higher this year. To list just a few of them, you have central banks buying it. You have central banks also cutting interest rates globally. You've got concerns about geopolitics and the elections going on globally. I mean, I just like this story for gold and silver, and I'm glad to see you're kind of on the same camp, at least with your silver idea. How would you manage that silver trade that you have?
Well, it's let me have a quick look. So we've got a hard take profit at 35.8. So yeah, it's a case of just trailing stops until take profit. I don't think this will be one we'd manually close out of unless there was some change in the global state. But yeah, it's kind of just a set and forget, really. Just protect it with a trailing stop and leave it. But yeah, as for gold, I mean, there's still, like you said, there's a lot of factors in play. We still have a lot of buying of gold by sort of the larger market participants, shall we say. So it's not like there's any selling of gold, really. China slowed down their gold reserves, but they're still buying just a much slower pace, which is still a green flag for gold in my book. So yeah, I think it's definitely the year of commodities. I don't see any reason to be sort of either selling them or closing positions. I think it's still wise to be either staying in long or looking to go long.
Well, and one thing you added about the kind of situation with China slowing purchasing, I think of it about, if you just kind of logically think, if you're the central bank of China and you are like out to buy gold, it's only natural to say, they were buying it for many months. So buying. Oh, it goes up a bunch, and you just say, okay, yeah, we're just going to pause. But as you've just said, they haven't completely stopped their purchasing. But also, what if that's just kind of a, we're going to say we're slowing so that maybe price can go down a little bit, but there is supporting buyers in the Bank of China, the Chinese central bank, that's saying, any dip, obviously, like they were buying it over here. So a dip in gold is probably somewhat supported by central bank buying. It's like
Yeah.
just natural if you're trying to accumulate gold at the lowest possible price, and the Chinese, central bank has a lot of US dollars to get rid of. They may just buy dipping opportunities. So to me, it's kind of another positive, is like you have that backdrop of central bank buying, probably steady and consistent, but maybe accelerates if the price goes down. So it's almost like a supportive measure to a degree.
Yeah, absolutely. I've got a friend that works at I think ACY Securities, which is a broker in Australia. I was having a discussion with him at the start of the year about gold, and he's been bullish on gold for a very long time. And he was saying that it's not even a question of buying or selling; it's more a case of treat it. Obviously, viewers don't take this literally. I'm not saying go and buy gold now, but at the time, it was a case of treat gold like an indice or an investment, in terms of just keep adding on to buy positions, because this whole year there's not really been any reason to sell. It's been a very, very bullish market, and it's been essentially free money if you could look at the economics and look at where gold is going and why. It's very clear buy positions, really.
Yeah. No, I mean, I obviously agree. Gold has been like my biggest kind of play this year. The other side has been technology. So I've been right in some ways, wrong in other ways. Obviously, the thing is, you could always kind of point to what you shoulda, coulda, woulda done. Like, even though I've played gold well this year, in hindsight, I should have just been 100% long technology, because that's the winner. But nobody knows where, the market's going to go for certainty. So I feel like, as you've said, there hasn't really been a huge bear case for gold that's come in this year. In my view, I've had mostly a bullish view almost all year long. And we'll see if that continues. I think, what do you think about the indices? They continue to trail higher. We talked about this yesterday, nothing to do up here per se. But do you think CPI and PPI could reverse some of this bullishness? And I guess, what are your thoughts on that?
I think we could see some slight movements. However, I'm not in this specific situation. Let's talk about NASDAQ, for example. It's not, in my view, it's not something that would suddenly change because of CPI or PPI. We might see, a spike either way, but because it's mainly Nvidia driving it, I think it will just continue trailing Nvidia or following Nvidia. So I don't really see, unless something drastic changes or something happens, I don't see any world where the NASDAQ just suddenly starts dropping, because it would require Nvidia to start dropping, which I think would take more of a company situation rather than something like PPI.
That's actually a really good point. So you're kind of saying what I would generally agree with, which is it's sort of less about the macro right now for companies. Like, the idea is like, okay, the Fed's going to cut interest rates. That's not really changing. You could argue if it's going to be once or twice this year, or zero, or maybe once next year, but the next move is they're going to probably cut interest rates. The next question, though, is, and this I could see being the more likely bearish scenario, in which you do see a drop in the NASDAQ, S&P, maybe a 5-10% correction. This would be earnings season going poorly.
Oh, yeah.
Like, if
absolutely.
Nvidia, so like you're saying, so like if it's something specific to the company, like if Nvidia has just a terrible earnings, or not even terrible, they're not going to, their numbers are going to be good. But if they're not excellent, exceeding is the word I'm looking for.
Yeah, well, that's kind of the thing. Nvidia's on this pedestal at the minute. It's all eyes are on Nvidia. It's such a high price. It's kind of like a unicorn. And if it underlives that unicorn perspective, it could, even, like you said, even if the numbers aren't terrible, it could still move the market down enough to just then allow some buyers in, or to have a 10% correction, for example. Yeah.
And I mean, if you look at my screen for a second here, we've got Nvidia is trading at a 74 PE, let's call it. It's trading at a expensive price. Now, it should be an expensive price. It's a company that has remarkable growth, remarkable earnings, but the point, I guess, is if there's even anything less than remarkable, the company could have a substantial drop. I mean, Nvidia dropped recently like 15%. And there was no like serious, obvious catalyst for why. There was just some speculation that, oh, well, some of the executives are selling shares. Like that's all I could find about it. There was just not
Yeah.
a lot about it. And it dropped 15%. So if you get something real for NVIDIA, like if you get something actually concerning, like, buying has really slowed by, their customers, then you have a catalyst for a bigger pullback in technology, which has been, again, led higher by, NVIDIA. So
Yeah.
something to think about.
Well, another bull case for Nvidia at the moment is apparently Nancy Pelosi bought into the 15% dip, and we all know her track record. So it might be a case of maybe she's got some early earnings reports or something. We'll see.
It has been true. Like her historical purchasing of NVIDIA has been like the best trades ever.
Yeah.
So, we'll see. I mean, to me, I don't bet on downside for NVIDIA or for, technology in general. I've mentioned that it's the only sector right now that I have long positions in. I did have an XLE position, but I got stopped out of it. So I was looking for energy to keep going, but with cooling jobs data, I'm a little bit more cautious on that now because oil prices may be due for a little bit more pullback with a slowing economy in the U.S. If that is going to be the theme here, we may see oil come down a little bit. So, what else are you watching? You have any ideas or trades that you're in currently, James?
Yeah, well, I'm still planning my big short on the pound. So there's a bank report that came out yesterday from UniCredit, basically highlighting the same thing that I've been discussing. And it's the first time I've seen it mentioned by an institution so far. And it's basically just saying that the economy is, it's facing huge problems, low productivity, high cost of living to a surge in economic inactivity. We've also got an energy crisis going on. And Labour, it's a case of Labour's said that they can fix these problems, but their plans to address are too timid to make a significant difference. And that's exactly what I think. And they've actually got all the data here to sort of back that up, which is nice. So that's
really interesting.
Yeah, I can go into that. I'll put it on Twitter or something after this. But yeah, it's I've been saying this for a couple of weeks now, but I am a perma bear on the pound. Although in the short term, I don't see any reason it couldn't go higher. So we can see here, this is another report by MUFG. So the pound is the best performing G10 currency this week, helped by expectations and a confirmation of the largest majorities for the Labour Party, which I think we all know that by now. We also have pressure on the euro, and then MUFG is recommending a long position on the Australian dollar, which again goes to my thesis. We've got a very strong Australian dollar, and we have done for quite some time now. And I'm also looking at the dollar bearishness. So I think, this week, well, in the near future, it's definitely shorts on the US dollar, longs on the pound for now, and then obviously longs on the Australian dollar, because I think it's at the moment we're in quite trending markets. We've got the yen and the Australian dollar that can be quite easily taken advantage of on pullbacks. So yeah, it's not too difficult to be a trader at the moment. You've also got the commodities markets that are doing quite well. So yeah, I think it's very, very clear, really.
Yeah, and James, I just wanted to pull up on the major currencies front on the EDGEFINDER. You mentioned a couple of charts there that beautifully kind of line up with your idea. So you've got in the short term, it's got pound USD bullish. I've actually been looking for a long position on AUD USD as well.
Yeah.
And it's got the strongest reading currently on the EDGEFINDER. Inflation out of the US this week will be impactful to this score potentially. But at the very least, there's just a number of things here that kind of show some strength for the Aussie dollar. And so, I've got this level marked up here. I'm if I can get this pullback, I may look to take a position on this when I'm watching this. I'm also watching EU in the short term for potential bullishness if I can get a setup there, but I'd love to see like a break of like 109. So we'll see. That would probably coincide with a break lower on the dollar index down to like 104. So that to me is a big trigger too. I think if you get 104 breaking, that's probably a very good signal that likely rate cuts are they're coming once or twice even for sure in 2024. So we'll see what happens with that. But gold, silver continue to push higher here this morning. The NASDAQ is flying through the highs, putting in another all-time intraday high right now. We've had just so many closes to all-time record highs. I know a lot of people get nervous about that when they see, all-time highs. But, usually all-time highs are here for a reason. Now, that doesn't mean that they won't. They usually will end eventually with a crash. Like a crash is always going to come at some point. But they could remain making new all-time highs for a very long time. And so we'll see. But again, continued bullishness on the index front. You mentioned a couple currencies that look interesting. So we will have to see. We've got a speech from Jerome Powell happening soon. I might let you go so you don't have to sit here and listen to an old man speak with me. But
Yep, no problem.
yeah, but before I do, let me just mention to everybody watching, we do have linked right here, Elite Traders information. So if you'd like to check out their services, what they offer, James and his team have a great little offering there that you can check out if you click that link. So take advantage of that. And James, thank you very much for coming on the show again for the second time this week. I appreciate your commentary, and it's always nice to hear your thoughts.
Yeah, you too. Thank you for having me. I hope you viewers have a great day, make some profits. I'll see you very soon.
Thanks, James. See you next time.
Yep.
All right. So, James mentioned it is it's an interesting time, for traders. I think if you're a momentum trader, this has just been a really pretty good year. And if you're a contrarian trader, I think it's been a tough year, man. I'm more on the trend side, which has been, nice this year, but there's also been years where it's been terrible to be a trend trader. But right now, like for example, if you're trying to catch the low on the Russell, it's been a terrible year. That's been the contrarian trade. The Dow Jones has been a contrarian trade. It's just gone sideways. A lot of people trying to broaden out on the rally, thinking, other components, other parts of the stock market. I mean, the thing is, man, it's like the only thing that's worked for me in stock indices this year, the only thing really has been comm services, technology, and semiconductors. It's like the only things that have worked well for me. I mean, XLK is my biggest, it's knocking on the door to be my biggest win ever. I bought this in April. This thing has rocketed, but look at so many other components of the US stock market, and they're just really disappointing. If you're buying basic materials or you're buying utility companies, I mean, this had a good run. It's given back a lot. If you're buying industrials, I mean, these are key parts of the US stock market. Discretionaries looked really good recently, or strong recently, although I'm a little hesitant about the weakening consumer, and this is kind of excited about rate cuts. But real estate, awful. Financials, flat for several months. What you're looking at here is a very, very narrow month. And I am shocked at how long I've been getting on these streams and I've been saying, oh, technology is up, semiconductors are up, everything else is unimpressive. It's actually amazing how narrow this market is. Now, does that look at this. NVIDIA is bright green. A bunch of the other areas are red. And then you have, here is your story on a 3-month basis. Look at this. Look at this. This has been crazy. Mostly red. And then comm services, technology, green. It's a very, what's the word I'm looking for? There's a vocab word I could throw in, try and sound smart. Oh, you ready? Guys ready? It's a very bifurcated market. Look it up. I don't know what it means, but it sounded good. So check it out. Anyways, I think we have Congress. He's about to get yelled at. Powell's about to stand up on stand and get yelled at. So maybe we can try and bring that in, James. We'll give it a shot.
Edited by too many people in this room. Corporations squeeze every last penny from Americans' pocketbooks and workers' paychecks. They don't even try to hide it anymore. The biggest corporations are charging more for less. Americans are frustrated. No, actually, Americans are pissed off. They have fewer and fewer choices. Those choices cost more and more. Keeping prices down is part of the Fed's mandate, but as many of us have made clear, the Fed's main tool to combat inflation, raising interest rates, does nothing to address the biggest causes of rising prices right now: corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. It's no surprise that since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Homeownership has long been a bedrock of our middle class, but today fewer and fewer middle class families can afford to buy a home. Higher interest rates are making our country's housing supply shortage worse, not better. We need more housing construction of all types. Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeling their budgets stretched by higher prices, taking on credit card debt to pay for groceries and other essentials has become an option of last resort. But as more people struggle to pay down their debts, credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee and explicitly stated that credit card issuers are charging higher rates far beyond what they need to cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month that the Fed keeps rates high, Mr. Chair, it costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to weigh these trade-offs and remember whose jobs and futures are at stake. It's why I've worked with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of the Wall Street business model that makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, but the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those communities, in those areas, and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost longtime reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust. A rule with no consequences is really not much of a rule at all. The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure our economy works for everyone, not just for Wall Street. The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Powell, for being with us this morning. Welcome back. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table. Real wage growth is being eaten away by rising prices and runaway inflation. Think about the fact that for 52 consecutive weeks under Joe Biden, wages were eclipsed by inflation for 52 consecutive paychecks. I remember back in December 2020, in South Carolina, gas was $1.99 per gallon. Today, it's still $3.19 per gallon.
These congressional hearings might be the most infuriating thing to me when we do these live streams. I feel like gaslit the whole time because these guys are not even discussing the Fed's mandate. They're just using this as a pedestal to push their own agendas and get votes. And it's so frustrating. Here's the thing. The first guy was like, oh, inflation's due to corporate greed. No, it's not. Companies, is there corporate greed? Sure. Absolutely. There's corporate greed. Don't get me wrong. But inflation comes from printing of a bajillion dollars. Who issues money printing? It's not the Fed as much as it is fiscal policy, right? Government creating tons of spending and programs and things like that. That's where inflation comes from. Inflation doesn't come from, oh, companies just want to rip us all off. No, if you understand capitalism, it's like if you raise the prices too much and people don't pay them, your business suffers. You have to raise prices to match the influx of currency supply, right? Everyone knows we printed a bajillion dollars. Of course, companies have to raise their prices. So to just attack corporate America for oh, you've raised your prices, you greedy monsters. Well, the money supply went up a ton. They had to raise their prices to make the same amount of real money, right? If $5 used to be $3, you have to charge $5. If you used to charge $3 and now $3 is $5, you see what I'm saying, right? Anyways, it frustrates me to listen to these guys. So to be honest, I think most of what Jerome Powell has said, He had a couple comments that were taken a little bit more hawkish, and I think we're going to transition here. Thanks, James, for pulling that up. I think we missed, to be honest, the initial publication from Jerome Powell. However, I did do a little research. We've got Powell saying, I'm going to just kind of read out some things that I found. He said the Federal Reserve will not reduce the target range for the Fed funds rate until there's greater confidence that inflation is sustainably moving towards the 2% goal. So, when Jerome Powell puts together these speeches, right? When they are, putting together his choice of words, his choice of what he calls the most attention to is really what people are looking at. They're, what does he sound the strongest on? Well, saying that they're not going to cut the Fed funds rate until greater confidence in inflation. Is that new? Not really. He's been saying that for some time. However, maybe the way he said it was taken a little bit hawkish. The committee will continue to assess incoming data and make decisions on a meeting-by-meeting basis, being cautious not to reduce policy restraint too soon, which could stall progress on inflation, or too late, which could weaken economic activity and employment. Key CPI and PPI data are also due this week. So we'll see. There we go. Okay, so in terms of a market reaction, we're going to get over to Chris Pulver in just a moment, hear what his thoughts are today. But I would say, you had a little bit of a mixed reaction. The dollar index jumped and then came back down. Gold, same story, dropped and it's bouncing a little bit. NASDAQ dropped, came right back. I think it's going to be just a formal conversation with Congress. And to be honest, so sometimes we watch these. I've watched these in the past, but I think I'm not going to watch it today because I remember the last time it is literally just person after person giving a political speech and hardly talking to Jerome Powell, and he just kind of has to sit there. So anyways, we're going to now transition. We're going to watch a quick break, and then we'll be joined by Chris Pulver to hear his thoughts on what the market is doing. Just to note, if you are looking for the speech or the conversation going on right now, we'll try and keep you updated with headlines, things that actually matter that are coming out of that room, rather than people pushing their agendas. So be right back, and we'll have Chris Pulver on the show. Stay tuned. If you're looking to add fundamental analysis to your trading, then look no further than our software tool, the EDGEFINDER. The EDGEFINDER allows traders to approach the markets by simplifying fundamental analysis into simple scoring systems. We look at economic data, technical readings, as well as sentiment analysis like the commitment of traders data to help traders spot potential opportunities in the markets through the use of data. Our tools allow traders to find top setups each and every day from the top setups page. You can also browse the latest institutional money flow through the commitment of traders data report that we've generated to make it very easy to read. And on this report, you can see everything from the latest overall net positionings, as well as the week-to-week buys and sells from institutional money. The EDGEFINDER also has a retail positioning tool, which allows you to see what the crowd is thinking about your favorite charts, symbols, both currencies, commodities, and indices. You can also check out the latest seasonal trends, month to month, week of the year, and much more to spot potential opportunities coming up in the future. The EDGEFINDER also makes economic data much more easy to read, like our GDP charts, our retail sales numbers, PMI data. We can also check out the jobs data, unemployment claims, and so much more. At the touch of a button, you can check out the latest reports from the economic data that moves the markets. Right now in the live stream chat, we'll be dropping a link where you can speak directly to a team member about getting yourself set up with a copy of the EDGEFINDER today, and we'll give you a nice live stream discount. Click that link and chat with the rep to find out what kind of discounts are going on right now. Now back to the stream. All right, Chris, and we are back for another episode. How's it going, man?
It is going well. I think the secret phrase for this week for me is hedging.
Interesting. Elaborate. What are you hedging with?
Well, I did some VIX hedging yesterday, as well as ES. So hedging with the S&P futures market. I'm trying to make
buying calls on the VIX, or what are you?
I'm buying a call. So I did a couple things. I've already got some in the money calls at $10 and $10.50. So that's essentially like full. If price goes up, then it'll be like essentially owning the VIX. But I also went out to the end of September and did a $20 out of the money call. I paid $1.65 for it. If I'm anywhere right on this, if we get a move on the VIX from, let's say, 12 and change like it is now to 20, that's really the move that I'm after. So I could turn about $1.65 into, maybe $5 to $6 of credit. So it'd be about a 3 to 4 to 1 hedge. My 1050 call, that would be, I'm trying to think here. I can turn a 450 debit into a 950 credit if we poke to $20. The bigger hedges for me are the ones that are the ES, so your S&P E-mini futures. Those pay like 20 to 1. They're way out of the money, but I did it where it cost me in my margin accounts, cost me nothing. I actually hedged for $100 credit that pays up to about 20 grand in hedging. And then I also did about a $350 debit in my IRA accounts because I wanted to make sure that the buying power wasn't sucked to nothing. So, but same thing. It's like I paid $350 for a hedge that pays out potentially, 20 grand. So, anyway, I'll explain why. You said elaborate. So, could we stretch this week, Nick? Nick, we have CPI data on Thursday. What's the last CPI move that we had? We just had a massive gap higher, right?
Yep. Because it was a good number, I think, last time around.
So it was a good number. The forecast for this go around is 3.1. You're sitting here talking about what Powell's comment is, what the testimony is going to be for the next 2 days, but it's all going to boil down to what is inflation on Thursday, what's CPI data, what's year over year. Look, 3.1 would be okay, but it doesn't change. Like, it's not a new low. If you pull up the EDGEFINDER, what was our lowest over the last 12 to 24 months? Probably 2.9. Was that at one point we're like, oh my gosh, we have so much deflationary pressure now? Does that sound right?
Yep. I think, yeah. So we came down to 2.9 and then have now kind of bounced back. And really, if you're looking at CPI, it's been flat for for some time here. It's been really unchanged over the last year. The difference is if it kind of depends which way you slice it up, because if you look at the PPI or if you look at PCE, they're down in the 2s, and then other people will say, well, you're still in the 3s on CPI, and then other people will say, well, unemployment's taking higher. There's some debate here as to whether or not the Fed is going to. I think the big swing would be if the Fed takes more seriously the rising unemployment at some point. I don't think we're quite there where they're going to really show red flags, because we're still coming off of like multi-year lows, in terms of unemployment rate. But it's interesting, Chris. It's an election year too. Is it going to just keep pumping higher if we see a rate cut? That's the other thing is, Chris, I'm only long. I don't know, since I've last talked to you, I ended up closing out my calls on XLK on a dip, and I'm still in them. It's the only thing I'm in terms of stock market exposure, is staying long tech. I bought this back in April. I sold calls once, didn't they expired worthless, sold it again, and I decided to buy back those calls I sold. I'm still in the trade. It's the only one I can really see right now. I would love the rotation trade, but I've got to see some proof of it. And at the same time, I'm trailing a stop on this, because if we don't see the rotation, if we don't see broadening out soon, I think it's a problem. I think it's an issue to have just such a narrow leadership for so long. So I am in the leader, but I'm cautious about it.
Yeah. And so in terms of your cautious, are you in with a stop? Are you in with protection? And again, look, man, this market's sitting here at 556. I'm looking at the SPY right now. 556, we're at, nearly 5,600 on the SPX. I don't know if we're going to see 6,000 on the S&P before we have a meaningful pullback. We've had 340 some trading days without a 2% pullback in a single day.
Yeah.
But some ominous signs out there would be that anytime we've had a 0.5 or 0.7% increase in unemployment rate, usually it's followed by a recession. It's certainly followed by a slowdown. I think a couple of things I took some note of on Monday. Right here's an interesting mark. So, we still have our sticky inflation. Let me see here. This is the running, unemployment rate versus non-farm. The trend of jobs numbers. Yes, we've had jobs numbers, but unemployment rate's been ticking higher. If we go to, I just pulled this morning from, I think it's Opening Bell Daily. Monthly bankruptcies reached the levels that we haven't seen since the start of the pandemic. So we're seeing some companies where, and there's a lot of ways to kind of get through this, right? I mean, if companies are struggling, we could enter a phase of mergers and acquisitions. That's usually, one type of way to consolidate. And I mean, we're seeing high concentration in the stock market. So it makes sense that corporate America would also be looking for high concentration. You've got, those that are producing, those that are making money, those that have the cash flow could be buying companies that are struggling for some type of advantage, lower competition. I mean, we could have a pretty serious season of mergers and acquisitions, but it doesn't overlook the fact that we are getting a rise in bankruptcies. We're getting a rise in delinquencies.
Yeah.
I've got a buddy of mine that works with me. He had sent me, let me find his message that he sent me. We do a little session on Sunday together, and he sent me a message. Where's it at here? Mortgage delinquencies are on the rise, which I thought, okay. I mean, look, this isn't, Big Short type stuff. This isn't 2007, 2008, but things are happening out there that I know the market appears to be ignoring. And look, by no means am I trying to be like a perma bear, because that's the worst situation to be in.
Sure.
But here's some data, right? Recession in the US usually comes in within 18 months from the last Fed rate hike. Well, it's been 12 months, right? It's been 12 months since the last Fed rate hike. We talked about this inverted yield curve from the 10 and the 2. And at 24 months, it's usually about the average when a recession hits. So, I mean, timing wise, we're talking about a potential rough fourth quarter. If this market's going to embrace a recession and price it in, Q4 is going to be rough. If this market ignores it, we get through the election cycle, we get through the year, and we have a solid Q4. It's hard not to be a little bit more jaded coming into 2025, but that's just where I'm at.
I typically agree, Chris. And that's the thing is, like, I'm like the most cautious bull that I've been in a long time. Like, because I actually think that if you're in the narrow camp, which I've pulled back to in the last month, I've kind of snapped back to, you know what? It's the only thing working. I'm going to trade the momentum until the momentum's gone and just stay in the trade, the tech trade that I've been in. I think it's almost a form of bearishness to a degree to just say, I'm just going to stay with the leaders and I don't trust the rest of it, because historically speaking, that can last some time. Narrow leadership, obviously it's lasted a long time here, but it can last a while. The Russell's like 4 years of vastly underperforming the S&P 500. The RSP is just up a couple percent on the year. Meanwhile, the weighted S&P 500 is up like 17. I mean, there are so many problems here that I see in the narrow leadership. And that is, again, why when you actually look at my actions personally, I'm long the only sector that I can really justify, which has the earnings, which is technology. Like they're, as you just mentioned, they could use all that cash flow to buy companies. The demand for chips is strong, but clearly that demand for chips, the AI trade, Chris, is not broadening. It's not showing up in the other areas. I'm concerned about the Russell. I want to buy the Russell so bad, but I am still waiting for the growth to materialize, and then I could build some positions in other areas. Maybe buy the RSP, maybe buy the Russell, but I've got to see the growth stay strong and inflation come down. I'm just struggling with it. So that's where I'm kind of back to I'm long gold, silver, and I'm just going to trail stops on the one thing I have that's working, which is tech. But it's a tricky market, man. I mean, it's like if you're not in the tech, it's like everything else. I mean, semis, technology, and comm services are up. Everything else is just okay. I mean, it's not terrible, but it's just not great. So it's been a frustrating time. And again, I think that, to be honest, if you look at historically, like thin leadership usually doesn't end very pretty. So yeah, we need to either see the broadening or I'm going to stay pretty cautious about this market.
Yeah, I think that's a wise play. I'm trying to narrow my portfolio, but protect it. I mean, I'm looking for income gen strategies that allow me to still make money every 30 to 60 days. That's a way for me to generate the alpha, right? I mean, if I'm just long, I'm moving right along with the market, which is fine. I mean, like you mentioned, Dude, the numbers are staggering, right? We're up 17% for the S&P, 25% for the NASDAQ, but we're up 4% and 1% for the Dow and the Russell. I mean, they're barely hanging on to positive gains this year. And what's crazy is Tesla, right, which was one of the most hated companies in 2024, is now back on the favorite list of it can't do anything wrong. I mean, I just
actually flat on the year. I mean,
well, it's at like 1% positive for the year, right? Like, I mean, we went from like a 40% drawdown from the top to now it's back up where it's positive year to date, but it's up like 2%. But this thing has ripped like 40% in the last couple of months, and it's just unbelievable. Now,
Frank's in on that
speaking,
one. I have no Tesla. Do you have any Tesla, Chris?
I do have some Tesla, but I don't know if I'm going to reestablish positions on Tesla simply because I'm like, well, if I did some ratio spreads, I did some puts. I mean, my price level, my strike, Nick, is 115. I'm like, right now, I can't get the same amount of money for a 115. If I want to own Tesla, I want to own it as cheap as possible. You know, I was in this camp of we're sitting here at this, you know, drawdown for the year. I'm looking at where would I own Tesla? $100. That was always the number. I'm like, if I'm going to own it, I'm going to own $100. I'll justify the 10 grand cash or the 5 grand margin to own it, and I'll work the cost. And all of a sudden, we just balloon for the last month. Really, it's the last like 2 weeks. This has been crazy. Exposure. I'm not long with any shares. I'm just long with options, and I closed out for some profit already. I had a leap that I closed out. It only took like 3 weeks, and I generated about 55% of the profit within the first 3 weeks of trading. Which it's a 360-day option that I generated in like 20 to 30 days. So it's crazy how price can do that. And I just thought, well, for me, I mean, I can either sit for another 11 months and wait for the other 50% to come off, or I can just redeploy that capital, which is what I decided to do. But anyway, we're right back in the wheelhouse of this. Seems like tech. This seems like Mag 7. This seems like the market is still just embracing this high concentration. The divergence that we've talked about between S&P, NASDAQ, which is virtually becoming the same index. I mean, it's not, but the only two are making new highs, S&P and S&P and the NASDAQ. Only two making new highs. Dow is still struggling, Russell struggling. So it's the same thing, man.
Yeah, just to add some context to what you're saying too, I've got it pulled up on my screen real quick, guys. The RSP is the equal weighted S&P 500. For those of you guys who are saying, why is the stock market like, if you feel gaslit by this market, if you're somebody who owns some industrials, if you're somebody who owns some healthcare, if you own financials, and you're saying, why the heck is the market so giddy about all-time highs? And I just keep hearing that, and my account's not doing anything. If that's you, then guess what? You are not alone. In fact, you are absolutely part of where most people are feeling frustrated with this market, which is why this market has had such a hated rally. This rally is like one of the most hated rallies I've seen in a long time. And it's because, this has been a year of momentum. If you've been in the ones that have been moving well and you've stayed in those, you've done well. And I'm telling you, I've not been in the right side of that for a lot of this year. Like, I've been looking for, I started this year looking for the Russell, looking for RSP, looking for, and I did, pivot out of that at some point, but it's been a tough year. It's been like, if you're not in the names, you're just kind of on the sidelines. Now, the thing is, you can talk about that in hindsight and you can look at that, but the question is, where do we go from here? And to be honest, I think that the tech melt up can last some time, but to chase it is also a very foolish thing. So I'm not saying, I'm out here buying heavy tech right now. I'm saying that I think that, you've got to stay. I think it's prudent, as you mentioned, Chris, like narrowing what you're looking at, staying, cash heavy. I think that's a wise thing in my personal opinion. If I've got gold and silver, that's kind of somewhat uncorrelated bets that I'm doing. But if those get trailed out and we see a big correction in the market, I'll have some cash on hand. So I think that's a prudent thing to do. And I think that, the lack of broadening is a serious, but here's the last thing I'll say, Chris, and then I'm going to hand it off to Frank, who's joined the call and to hop off. Last thing I'll say is, somebody asked me, what's going to get this market to actually pull back? Where would you actually see a sell-off in NAS and S&P? And I don't personally think, I mean, CPI, PPI could cause some volatility, but I think it's earnings season. Like if you actually get slowing in earnings, that's the one thing I really see as a possible candidate right now, because the Fed is still likely to cut rates as their next move. But if earnings slow down and you have thin leadership, earnings in those, I mean, if the big ones fall, it's trouble, right?
Of course. I mean, that's we're sitting in the house of cards for that exact reason. I mean, if you can you imagine the darlings of Mag 7 that all of a sudden are disappointing with earnings. I mean, you would have look at Nvidia of what it did when it reached like 3.3 trillion dollars in market cap, and then within what 3 trading days it was down to 2.9. It shed $300 billion in market cap in 3 days of trading. So
And Chris,
it's that type of
didn't even
sensitivity.
come on an earnings season. That wasn't even
No,
an
that
earnings
was just trading. But I'm just saying, like, that's when we, all of a sudden Nvidia's number one in the world, and quickly it was not. So, the earnings season, and I think that the market, is expecting good earnings, and I feel like, man, if you better hope that you have these companies out there that are forecasting some conservative measurements, because if they're trying to forecast, look, if Frank's joined me a lot for earnings season this year. I've had a pretty good Q1, Q2 of earnings. Well, I should say it's Q4 earnings, Q1 earnings to date. I mean, I probably won about 80+% of my trades in earnings, but I'm also very meticulous in how I pick and how I price them out. And we've seen a lot of expected moves, if not beyond expected moves, which has made it very easy to trade earnings.
Sure.
I know it's summertime. I know it's slow, but man, those household names. I mean, we're going to kick things off on Friday with financials. And that's never like an exciting. I don't trade banks for. I mean, they're low beta and they're super low volatility, but they're kind of the leader when it comes to. They kick things off typically. What's the strength of investment banks? What's the strength of these? The too big to fail.
And signals for the consumer, right? What are deposits looking like? What is savings looking like? Incredibly valuable stuff. And that's Friday. So this week is stacked on stacked on stacked. You got Powell today, Capitol Hill. You got CPI, PPI this week. You got bank earnings. I mean, it is a loaded burger this week. So, Chris, I'm gonna step out. I'm gonna give you the floor with Frank for a little bit here. As I do that, I'm just gonna let everybody know, if you're watching, if you enjoyed this commentary from Chris, do us a big favor. Make sure to go follow Chris. He has his own Discord channel. It's free to join. His YouTube channel, you can find him on Twitter at Real Chris Pulver. And we'll drop the link to his channel here in the live chat if you're watching on YouTube. And if you're watching on Twitter, maybe we can, well, actually, it's just at Real Chris Pulver. So there you go. Chris, we're going to run a quick break here, and then we'll set you up with Frank. You guys got the show for a little bit. Is that cool?
Perfect. Thanks, Nick.
All right. See you back tomorrow.
Attention A1 Trading Show fans. If you're looking to connect with other traders around the globe, consider joining our Discord community. Inside of the group, you'll be able to join our chat rooms, check out our educational material, our coaching webinars, and more. Within the group, our top traders share their trade alerts, which will send notifications to your phone or desktop whenever we take a trade. Our trade alerts come with entries, exits, and full analysis with every trade shared. This is not a blind copy signal service, but instead offers an educational way of looking over the shoulder of our experienced team. For fans of the show, we're offering major discounts for a limited time. To claim your discount now and join the group, click the link that's just been dropped in the live chat, which will connect you to one of our trained support reps here at A1 Trading. Again, click the link that's just been dropped, or find the link in the description of this live stream, and you'll be connected with someone right away. Now, back to the A1 Trading Show.
Hey, Chris.
Frank. What up, man?
How's it going?
Good. How are you?
Pretty good. Been a busy week so far. How about you?
Extremely busy week. Most of it's aftermarket hours, so that's not a big deal. But I get to be on the road today for about 3 hours after market close. So I'm looking
doing what?
I've got a loaner right now for my vehicle. I've got some things going on with my SUV, so I'm taking that in. I've got to go pick up some stuff. I got golf camp starting in the evenings this week. They start today, so all that fun stuff with that, all that side hustle stuff, all the golf camps, the golf instruction. So yeah.
How's your arm doing, or is it your shoulder?
It's my arm. I'm actually going to get some physical therapy tonight. I've started some dry needling. I don't know if anybody's ever done that for physical therapy, but it was the first time in probably 4 months that I've seen some almost instant improvement. So I'm a fan, and I'm working with a good team. They're about an hour away. So yeah, going to do some more of that. I did play. I played 2 rounds of golf. I think first time I shared, I shot 3 under. Second round, I shot 2 under. So maybe the next time I'll shoot 1 under, and it'll just keep getting worse and worse. But anyway, I'm trying to reestablish my handicap for the year. I got a big tournament coming up in November in the Tampa area. So I'm going to try to go there and win some money.
Well, good luck on that.
Yeah, exactly.
Talking about shooting 3 under, I'm shooting like 5 over when I go out there.
Still,
but granted, that was once. I still have more.
That was once.
I've only played 18 holes once, so I need to keep playing, I guess.
Yeah. Well, I will be in your guys' neck of the woods again in August. I'm doing a conference with Tasty in August, so I figured I'd stop into your office again if you guys are around. I think that the conference is going to be on a Saturday, but I've got family close enough that I might pop in and see you guys and do a little office visit again if you guys will have me. Yeah.
Yeah, we'll think about it.
I know. All right. Well,
We'll
I mean, I'm very best, I guess, if it'll get me in the door.
No.
So anyway, dude, what are you looking at this week, man? I was on the session yesterday. I think I came in around like 10:20 or 10:30, but I put some live trades on during the session, and a lot of it was around hedging. I wanted to share a couple of things with you if interested. I'm continuing to do this SPX daily situation where I just look at the market. I kind of stabilize myself around a center price. Today on the SPX, I sold it around the 55.80 level. So, I should say I centered it rather around the 55.80 level. And so above it and below it, we've gone enough. It's only 10:41 in the morning Eastern time, and it's already enough to drain out that 15% take profit. So I've been doing this quite a bit on the SPX. I've had only 1 loss out of all of the days I started this back in the middle of June. So almost a month worth of trading, and I've had let me just count here. I think I'm like 16 out of 17 winners, so not too bad. And lesson learned on the loser, because that was a trade I took for the rest of the day. But I pretty much have a hard stop by like 12:30 p.m., 1 p.m. Eastern time. You got to be out of this trade regardless, and usually by 10:30, 11 o'clock in the morning, you're out of the trade for profit. So I still like that trade. I mean, you've seen me do that for the last month on the show. And it continues to be a trade that works out pretty nicely for this first little, chop zone. And anyway, so I looked at that in SPX. I've also been trading a lot more. I did request a commission reduction from Tasty on my futures accounts, because I finally got all of my clients approved for futures trading. So I'm doing a lot more ES. I'm doing a lot more MES. I'm doing a lot more NQ, MNQ. Those are just future symbols. So thought it was interesting. If you want to take a look at a couple of things, are you interested in hedging, my friend? Because if you are, I've got some news for you.
Yeah, I'm doing it right now, kind of. I've talked about it with you like last week when I was saying I'm doing longer term, short calls, just longer term, waiting for any potential move. They're out of the money. They're cheap. It's not really. I don't think it would necessarily outweigh my weight to the long side, but it's something there for now just to protect. But if you have like another hedging idea, are you talking about?
So what are you doing? You said short
out?
Calls. Are you sure? How are you hedging again? You said short calls. That's not really a hedge. What are you doing again?
No, it's not a contract. I was just saying calls as in like different plays. So
okay.
I have long-term puts. I actually do have calls on the VIX, but they're not, they're out of the money, and it's like a month out. And when they get to close to expiration, I just close out and open another call for a month out or something. Sure. So I take a little loss every single time, but if something happens where all my long trades on the SPY and different indices pull all the way back, maybe the VIX will help me out some. So That's
Sure.
kind of what.
Well, that's an easy one. I've got two plays on the VIX right now, and then I'll show you what I'm doing on the ES. So it's the futures S&P. So for the VIX, I have two approaches here. My timeline is, I think I went out through middle of August on one. Let me double check this here. So if I go to the VIX, here we go. So I have the August 21st 1050 call, and then I have a October 16th $20 call. Obviously, one is in the money, one is out of the money. The 1050 call is in the money. I was going for a 70 delta. Usually when I'm long on something directionally, I try to go in the money so I can get that delta to essentially appreciate from like 70 to 100. What that means is that's the same as being long the stock. You can't be long the VIX, but you can trade options around it. So I'm long the VIX from that capacity. I don't know if I timed this well enough, with this in the money 1050 call. But I think I'm giving myself enough time for any type of, even a short-term volatility event on the VIX that pops us up to, 14, 15. That might be enough to clear my 1050 call and get me out for a couple of $1,000 of profit, just again, hedge. But I think that a reasonable spike up, if we have a downturn or any type of meaningful correction, we're probably going to see the VIX spike up towards 20, which right now from a $12 position to a $20+ move, that's a 70% uptick in the VIX. Now, does that quickly get faded? You have to remember that the VIX is something that likes to mean revert. Stocks don't necessarily have to do that. So, we spent a lot of time this year looking at just crazy amounts of divergence between what's performing well, what's underperforming. And it doesn't mean it has to all of a sudden shift. That's the big debate this year is tech going to mean revert to value? Maybe not, right? I don't know. But the VIX, it doesn't stay up forever. Even you go back to the biggest crises we've seen. 2020's COVID crash, we got to the same highs, if not higher than what we saw in 2008. We could spike up a lot higher if things get nasty. Problem is, I don't think that's going to happen. I think we're going to, if we have some type of correction, we break the streak of 340 some trading days with no 2% pullbacks in a day. If we have those type of days, or have one of those days, then we'll see a big move in the VIX. But don't be surprised if we see a big move in the VIX that it gets faded right back down. So any type of correction that we see, obviously I'm kind of prepping for it. I'm not overly bearish, but again, I just can't ignore just the technicals that I've seen for years and years and years. You just see this lined red, like overbought conditions. So I'll show it on my chart here. This right here, overbought conditions, overbought conditions, overbought conditions, overbought conditions, overbought conditions, overbought conditions, and it's divergence. Now, you might be saying like, well, that's crazy. It's clearly, that indicator's too early. Not really. I just go to a higher time frame. And this is where I'm at. So the last time we saw this thing print on a weekly time frame, it was right there, and we did have a top. The last time you see this print, we have it now. If I know you can't see it with my little wedge figure here, but there is overbought conditions with divergence on a weekly time frame. And again, the hardest thing to do is call that top. But this is why, just like you would have been following it here. Oops, that's not drawn very well. If you plot a trend line and it breaks the trend line, the market did sell off. So if I look for some confirmation, you and I have talked about this, the hardest thing is going to be to pick this top. You would mention, 5560 or I'm sorry, a 5600 on the SPX or, 560 on the SPY. That makes sense. But to me, the bigger, obvious resistance zone is going to be in the 6,000s. If I'm going to short this market, I'm going to start shorting it at 6,000. Right now, this is the market that refuses to go down, the market that refuses to go anywhere but up or sideways. It's like sideways isn't bad, right? Sideways is just frustrating for traders that are like, is this where the top is going to be, or is this where the market's going to base again? I'm thinking of just been in these markets for a long time. It's weird to see so much into so few stocks. That is weird. What it does show us is that market can stay resilient in a lot of different ways. Maybe that's exactly how it was crafted. I know that everyone loves Bitcoin because it's supposed to be the greatest asset ever, and that's how it was created with limited supply. That's all changed with Mt. Gox, right? But we're sitting here with the S&P with market cap weighted and the Qs at market cap weighted, and you're looking at the top 5, top 10 holdings doing most of the work, most of the heavy lifting. So, to Nick's point before he jumped off the stream, I mean, earnings season is approaching, man. And so if you and I want to kick around some, week to week earnings, I'm happy to do that because I'm interested in some of the pricing. But here's what I'll say. Going into earnings season, if we see the market deal with like complacency, and let's say that the market sees a lot of as expected earnings instead of blowout earnings, that's going to be a tough earnings season if you're trying to get long, beyond the expected moves. I will probably take a different stance with this earnings go around and do a lot of the credit spreads and do the in the money credit spreads simply because it's way more cost effective. I'm collecting like 65, 70 cents on the dollar. I can go both directions and have it be where my biggest loss on one contract might be a couple $100. My biggest winner is going to be $400 or $500, something like that. And I can take profit pretty regularly. So I will probably stick to in the money credit spreads instead of those, kind of omni spreads or those, those kind of dual debit spreads, simply because maybe we have, beyond expected moves for Q1, Q2 of this year. We're coming into Q3 to print Q2 earnings. I don't know, man. I guess I'm clearly clearly spewing some hesitation. I mean, I'm skeptical that this market can keep sustaining these runs, but I'm not necessarily turning full bearish. I'm just playing some hedges. So anyway, back to that initial thought, you're hedging on some short terms, you're getting some directions. I mean, I have a couple trades running right here. I'll show you. So the E-mini futures, this is the ES signal or symbol. I am going out. Let's see here. This is a pretty good looking trade. Most of these are, let's see here. This one is, did I pay for this? Oh yeah, that's just a long put. Okay. So two ways I'm playing this. Okay. I'll make this really simple. So I'm playing this two ways. One is I'm trying to get essentially a free hedge or a credit hedge. And then the other way is I'm just making it like a 20-to-1, really out of the money, ridiculous kind of almost like a black swan hedge, but I'll type this on the chart really quickly. So I'll put free in quotes because it just requires some options, but a free hedge is one way to do it. And I'll explain that. And then also and I'll put a cheap hedge.
Hey, what are your thoughts on Nike?
Well, I told you I'm long on Nike, and I'll come back to the hedging in just a second. But I'm long on Nike, but my level is going to be $60. And so as soon as we had that giant miss in earnings and we pushed lower, I mean, we're talking about below the lows of 2022. If we come back into this level at COVID at $60, I want to take some positions on Nike and be long.
That's where I want to.
I did it with a leap. I just went out to the $60 put. I did a 60 and a 55. I think it's right here. Yeah, so I did a 60, a 55, and a 50 put. So those are naked puts. Those are cash secured puts. I don't mind owning Nike there. If I took 300 shares of Nike at a break even of $55, I'm confident from COVID crash lows I can repair that stock. So I mean, I'm willing to tie up some capital with that. I don't think I'm going to get assigned if we stabilize, but directionally, it's like. What has been hit hard? It's like, think about some of the momentum that we've seen here. What's been hit hard to the downside is still staying sluggish. Like Nike after this dump, we need to stabilize. But look, Nike took out all these lows. There's a really strong level support. So Frank, I think that we might just gravitate towards that level support to see where the buyers are interested in trying to find a dip on Nike.
Yes, but even then, they still have a awful projection for 25. So I like what I've noticed is that it's probably a little less now, but it's like 20% off its COVID lows, which is when this happened back in 2020. I was thinking we're never going to see prices here ever again. And like we missed our shot, but
right.
But now,
not so much.
Now it's been on a 2-year drop and just, the demand and whatever is just declining for this stock. But now it's back here. So I've been wondering, even if it does come down all the way to that low that you're pointing out, what are the odds that it can bounce from, in the span of like a year or so, I feel like if the company's going to continue to underperform and retail their sales are just going to be really bad, should we even consider this stock right now, or should we, wait for maybe an even better opportunity? Or are you just going to buy and then I guess sell calls and lower your cost basis or something?
Yeah. If I get assigned on shares at $60 or lower, I'm going to turn it into a wheel strategy where I'll sell calls against it. I mean, I'm not looking at this like I want long-term ownership on Nike. I'm looking at this as if I own the shares, see if I can make, $2, $3, $5 a share and then flip it. I mean, it's not something I'm looking for long-term gains. Same thing here. I look at this right now. I mean, if I looked at let me see if I pulled up let's look at like RSI. Let me bring up one more workspace here. Hopefully this doesn't water me down too much. Let me look at one more workspace on Nike. What's up, dude? Dog just roaming around in the background. Yeah, he's behind me. All right, so let's go Nike here. And I want to see if that daily, weekly push to the downside got us into some oversold territory. So here we are. This is the daily chart on Nike, and we are pushing. So that push to the downside, I mean, that completely pushed our RSI into oversold territory, which again could justify a little bit of a gap fill. What's an easy way to do this, Frank? I don't want to buy a call necessarily because then I have to pay for that, and my break even is going to be higher. If I went in the money, and let's take a look at this one really quickly. So I can go in the money on a call and try to make the break even right around current price. And if price goes up at all, there's some, intrinsic value we can build into that option trade. It's going to be expensive though. The other one would be, what if we just did a credit spread? I mean, the IV on Nike has to be reasonably high. No, I take that back, 22.6. But if I looked at Nike, let's say out 45 to 70 days, maybe 45 days might be the perfect time. I think if we get into September, September effect is usually September historically is the worst month of the year. So why? There's tax loss harvesting. It's coming out of the summer. There's profit taking going into, end of the summer. And then people kind of reposition for, okay, they take losses, they clean the portfolio, and then look forward to Q4 starting October. But I think if I went out to September, I wouldn't love that. If I went out to August, I could probably justify the August 16th or August 23rd. I'm not sure when Jackson Hole is, but I do expect some volatility there. Point is, what would we look at here if I did a bull put spread? And it's awful. If I was going to say, like, right now we're at $74, could we just push a little bit lower? Yeah, maybe. But if I did an at the money, it's going to be probably 30 to 40 cents on the dollar. Let's find out. So for a dollar spread, I can get 26 cents of credit, which I don't love. For at the money, I can get 60 cents on the dollar, which is okay. So we're trading at 74.06. I could do a 74 by 73. I mean, Frank, this isn't a bad play, dude. By August 23rd, is Nike going to be back above $74 or not? That's one possibility. So you're making a stance to say, if this is above $74, which means from now until August, does this have a little bit of a push to the upside? We have earnings on Nike in September. So we have this runway where there's no real earnings to kind of stabilize this. There's no real catalyst outside of maybe the broader market, moving around, or the S&P as a whole moving around to maybe weigh on this sector and weigh on this retailer. But there's two ways I would think of it. This is a cheap trade, right? If I can get 55 to 60 cents on the dollar, that's not a bad trade. The odds of assignment, I mean, this would be a position. I'm not taking assignment at $74. I'll take assignment at 60. But if it stays here at 74, stays around 74, stays above 74, this is an easy way to make 55 to 60 cents. So that's one way to trade it. And that's going to cost next to nothing. I mean, your buying power is going to be like $50. Okay. The other way would be if you wanted to buy Nike, let's say you did like a $70 call. Well, this is where you pay for the debit. But if we just stay where we are, you're going to be down about $1 if we stay where we are, which again is manageable. If we go up, this is what's kind of nice about this. If we go up and fill that gap, let's say we come in and find this little pivot cluster around $82. That's an $8 move on this instrument. If we fill the gap, we're talking about a $15 move. So if I bought a $70 call and we go up to, $82, that's a $12 credit, which would help me make about $6 to $7 of profit. If we go up towards $88, that's an $18 credit, which makes another $12 to $13 of credit. Does that make sense?
Yeah.
So, I mean, so in the money call, it's more expensive, but you actually would get more profit potential if price stabilizes. You kind of maintain. If price goes up to gap fill, you're not as sensitive to the time, right? Like if I do a credit spread, I need to see price stabilize for the next 45 days and stay there.
Yeah, I would rather do a credit spread than a straight up call option on this, because timing is going to be really tricky, and even though credit spread is timing, you're going to pay for it more if you don't do a spread like that. But
true.
Are you saying that, okay, so you're at 70 and then 75 or something?
Well, current price is trading around $74. So you're
right.
saying
your call, you bought a call at 70, or this is the theoretical.
Yep.
Trade.
So there's two trades. One trade is cheap, cost effective. You would sell the 74 put and then buy the 73 put, grab about 50 to 55 cents. That's a very binary trade, right? It either goes up and stays above 74, make your money, make your 50 cents, or if it loses, you lose 50 cents. Big deal. It's a very straightforward trade. Time does not work against you in this trade, right? So if we stay where we are, you get your 50 to 55 cents. Awesome. You've got all the time until expiration to see if price stabilizes. The nice thing is, do you have to hang on to this all the way to expiration on August 23rd? Not necessarily. If price goes back up and fills the gap, this is going to be trading for probably a 30-cent debit, maybe a 25-cent debit, maybe a 20-cent debit. You can take some partial profits if price goes up. Okay. That's one trade. That's very cost effective, and time works in your favor because you're just getting more decay out of the trade in it, see if it stabilizes around current prices.
Right.
If you're looking for more profit potential, I mean, maybe you're not that excited about making 50 cents. If you're looking for more profit potential, but again, time sensitivity wise, this is going out, 45 days. If I took this out, let me see if I can do this to the end of August. I think that might be it. August 23rd. So there's no August 30th, unfortunately. Where we'd have to fill that in, but that's going to be, down the road where it goes like weekly options. So August 23rd looks reasonable. You're out 45 days. The reason I like $70 as a strike is because that's right around that 70 delta. If price goes up from here to fill that gap, you're going to get not only the intrinsic value that you're buying into the trade for. So look at the cost of this, Frank. So I take a $70 call, I'm paying $5.25. Well, that makes my break even 75.25.
25.
Yep. But if we come back and fill a gap, or we find a pivot, that pivot's around 82. Okay, 82 and change, or we fill the gap. We're coming up to 88.50 for structure. We fill the gap at 92 to 93. Is this a turnaround story for Nike? I think that's a difficult assumption because they were so pessimistic on their forward guidance that this is where I would say it's going to cost more and it's going to be a bigger risk because Nike doesn't seem overly optimistic about the next, let's say 6 to 12 months. They could have a positive earnings print. I mean, I've got plenty of sneakers from Nike that shows that they're doing well. But I only buy stuff on sale. So maybe I'm a terrible consumer. But I think, the cost effective way to trade it is a credit spread. It's a win-lose. If I lost 50 cents, I'm not hurt by it. If I make 50 cents, I'm not impressed by that either. So I just think that's kind of the smart play for right now. And I would do the same thing here. If I took a trade now in a credit spread and it didn't go well and I lost, I would be willing to rearm that credit spread if we pushed lower. Right now, and again, I hate being super early to trades, but if we're right, get paid, awesome. If we're wrong, reload and maybe double the contract size. So if I started with one contract now and I lose and I get another 2 contracts, I do another 4 contracts, I've got the buying power to do that. I mean, I can turn this into a winning result at some point if I'm doing like those 45 to 60 day credit spreads.
Yeah.
So I'll tell you what, dude. Just since we're talking about it, I don't mind taking the trade. I'm going to try to get, we're at 74, 73. I don't like that this is a slightly in the money strike and I'm getting less than 50 cents of credit. So that's not ideal. I'm going to try to get.
I
So let me
don't
see if I
really
can
like
get
this
55
trade.
cents.
I'm gonna be honest. I wouldn't take a trade just because we're talking about it. I
Well,
like
look,
55 cents, and this is a month out. I don't know.
well, okay? So what's a month out? I mean, if we have a downturn, okay, so I take a 50-cent loss on Nike, and then, like I said, dude, if it goes down, I mean, again, get rid of this for a second. If this goes down to $60, I don't lose anything more than 50 cents. This stock can drop another, 18%, and I'm going to lose nothing but 50 cents on the trade. It's not a big deal. Now, the reason I'm not like lollygagging in the trade. I'm just saying, if this goes down, I know my risk is defined, right? I'd much rather lose 50 cents than lose $5 and change. So and here's why this would be okay. If Nike just stabilizes and comes back up towards, $77, $78, $79, this credit spread's probably fine, And if it goes up and fills the gap, I'm obviously missing out on the direction, but I'm still getting a very simple trade that's risk defined for that 50 to 55 cents. And if I'm wrong, I can get back. What's that?
Sorry. If it could go down another 18%, what if you just did a put spread to the downside to $60? You did like 74 to 60.
So now you want to buy a put at the money and go down to 60. You're going to pay $2 for that put for potentially, $12 in credit, which is a great trade. But what are you fighting against? I mean, what are you going to fight against? You're going to fight against. You're going to fight against what the market always does, which is finds a way to justify buying stock. I mean, Nike is down. I get it, but when Nike is down on a daily chart with oversold conditions, when's the last time we were extremely oversold? Right here when we had a bottom and Nike ripped to the upside. Last time we were oversold, Nike was at a bottom, we had the upside. I mean, if you just look at this chart, this goes back, to 2022. That bottom right there, we went up from there. That bottom right there, we went up from there. That bottom, I mean, anytime you've seen it oversold to this degree, price has gone up. So that's a good sign. Now let me take this one step further, go to the weekly chart. Okay. Weekly chart. Weekly chart, you can see all those like previous levels we haven't quite ever reached overbought or oversold on the weekly chart. So I don't know if we're going to see oversold conditions on Nike on the weekly time frame. If we do, we're probably coming back into these COVID lows. So maybe the weekly is like, I could be more patient waiting for the weekly, but we might not get it. This bottom here, we didn't hit oversold conditions. What's interesting on this little look is price was here, price is here, and we're barely making a nudge with momentum. So I know that we pushed down lower, but I mean, if we go any lower here, Frank, I'm going to be looking for a divergence on my momentum oscillator, and I'm still going to be long on Nike, dude. So your put spread is cheap. If you did the debit spread, pay $2 and get $12 of credit, you need price to drop. Is Nike going to fall another $12? Maybe, but I don't think so. I mean, this was a bit of an overreaction. I could see price stabilizing, and I think that maybe a credit spread. And also remember, it's IV contraction, right? When the earnings came out, IV was really, really high. Over the last, what looks like maybe 5-10 days of trading, the IV's shrinking and contracting. We're only at 22 on the IV rank, which isn't that high. So, anyway.
I think I'd rather just buy it, to be honest, instead of trading it, trying to guess where it will go in the next month. I mean, this is lower than I thought I'd ever see it again. So
sure,
why not just buy it?
Yeah,
but I'm not really. So far this week, there hasn't been much. I closed out on my gold trade. I guess I got trailed out of it. So there isn't really much going on yet. I think going into CPI, it might just be like this, where the market kind of looks like it's going to shoot higher and then it pulls back and then remains sideways. But I think I might just wait for CPI because that's pretty much all that we'll need to know for the weeks going forward. But yeah.
I mean, this will be the big round of data. So we have CPI this week, right? CPI PPI combo this week. And then after that, like it's going to be kind of the silent window of it's going to be filled by earnings, right? So I mean, from this week's CPI data, then it's going to be earnings season kicking off, and then we're going to be we'll be having this conversation at Jackson Hole in August. So that's really the gap fill. It's this week's CPI. Maybe that moves the needle on the CME watch tool, right? The Fed watch tool. Is it making it a higher probability or lower probability? Then you fill in the gap from now until Jackson Hole with all earnings. I mean, I think the market is expecting good earnings. I think that's the overall consensus. But I don't know how the earnings season is going to be a broad market lift. I hope that it is. If the market's going to continue this rally, we've got to have a broader market participation, in my opinion. Otherwise, it just seems like we're in these, 100th percentile of concentration. And that to me is room for, it's reason to be very cautious. That's all. Not bearish, cautious, just very cautious. So anyway,
Nike, all a reason to be cautious.
Yeah, and I am cautious. And so let's go back to the original conversation, which I said about hedging. So I said there's a free hedge and then there's a cheap hedge. So futures up again the last 4 or 5 days of trading. These are my levels. I think my text just disappeared here. But my hedge is, so in yellow, I'm essentially doing a put spread. So I bought a put here. Okay, I bought a put here and I sold a put here, and then I have a naked put here. And so that area is a trap where I take the trade and it looks like this. So because it's a naked put, there's potentially undefined risk, but I've got a stop loss on that put anyway. So it's something like this. It's going to be, there's my risk, there's my trap, and there's my credit. So that's how the trade is constructed, where price is up here. Right. So price is way up here, and price can fall. I mean, we can fall like double digits for me to have any type of risk in the trade. We would have to fall 9.5% in the next probably 30 to 40 days in order for that trade to be threatened. Otherwise, it's going to be an income trade where if it does nothing but go sideways or go up, I'm going to make like $100 a contract. And if it goes down and comes into this yellow box that I have here, this is where I start to max out some profit. This yellow box can pay me up to $4,000. So I'm already getting about $100 of profit if it goes sideways or up. If price goes down and falls below this yellow box, then I'm looking at maybe $2 to $4 grand of profit. So I'm 2 to 4K in profit. Okay. And then my, potential assignment, I'm not taking assignment on ES because it's a $5,000 instrument. I don't care if it's futures or not. I'm not taking assignment. But that's where my position is threatened. We'd have to fall 9.5% for this to be like, oh, fudge. So I think over the next 30 to 45 days, anything is possible, but that's highly unlikely. This trade is already showing me a 99% chance of profit. I don't see that change a lot. So anyway, that's what I'm doing. So I've got some of those out for, August and September. I've got some of those out through September, October. I'm trying to do it where it doesn't cost me anything. The other one that I have is just the cheap hedge, which is I'm way the fudge down here. I did a 4,800 put. I think I paid maybe $500 for this trade. So I think I paid $500 for this trade, and it pays up to $20,000. If we have just the SHIT trade, it's a big payoff. So it's just something where it's like, I don't want it to cost me a bunch. I'm putting on 0.5% to 1% risk on the trade. I know that I'm risking on a hedge, right? If I hedge, it is to make sure that if something happens, my hedge is helping me wash away the drawdown. If I see the whole market go down, I don't want my portfolio to be dollar for dollar going with it. I'm trying to reduce that correlation. And for that instance, hedging is important. So anyway, that's what I'm doing. ES is a good way to do it. VIX is a good way to do it. I probably tied up about 2% in hedges that pay off maybe 15 to 20% in returns. But of course, I mean, if my portfolio is down, even though I'm not really that correlated, if it's down as a whole, I'm still trying to just wash away some of the bad stuff and mitigate those drawdowns with some hedges. Anyway, that's where I'm at there. And then go ahead.
What else are you looking at? Were you just trying to explain your hedge, or are you in BABA too? Are you doing the wheel for that?
So Baidu is the one that I own. Baba, I just have some longer term puts on Baba. Baidu I own at $90, and this actually is repairing pretty nicely. Let me go into my platform here. So let me go to Baba. So look, I know that here's my stance on China. I'm early. I say early, but basically I just saw a nasty price reversal from March's rip. March was great. I made a ton of profits in March. Had actually China profits carried into April as well. I had a great May for the portfolio, but since we saw the peak right here, this is a peak in Baba around April, May. You know, we've had a huge retracement. Now, like I said, I'm probably early, but I look at the technicals here, and I'm still interested in getting long on this stock. Now, you know, we came back down to, you know, below $90. We have lows here $80. If this actually settles in for a double bottom, I will be putting more positions on for that type of trade back up towards 150. You know, I do think China, for all the geopolitical tensions and the optics of it's uninvestable and all this other crap, I'm still trading China simply because I like having some non-US correlations. I like having some world exposure, and I do think that technically Baidu makes a ton of cash, makes a bunch of money. So does Baba. I think these are companies that are big enough that they want Western money. And I like the technical setup. So anyway, I own the shares right now. You can see right here I've got break evens. So I took some assignment. I own the shares around $97 for some of my managed accounts, and I personally own it at $90. And I've got it covered out to like 102, and I'm just hanging out right now. So I'm trying to make some, you know, I'm trying to lower the cost and repair the trade. Here's a position on Baba, or I'm sorry, Baidu. Yeah. So we're at 92.18. I put in a collar trade on this where if it dropped below 80, I'm getting paid on that. Otherwise, it's financed. So I have a covered call at 110. That covered call financed the put at 80. So I own the shares around 97. If they get called away, they're getting called at 110. So I'll make, you know, 12 to 13 bucks a share. This is out to August, so I'm just going to sit on this for right now. But I will continue to kind of collar this and give myself maybe $5 or $10 of upside. What I'm trying not to do, Frank, though, is choke my profits out. If all of a sudden we start to see that, you know, this is starting to head higher, I don't really want to shortcut, or I want to shortchange my profits, because I think this has potential to be a 150 to 160 stock. And if this is a double bottom, this is kind of what I'm hoping for. If this is truly a double bottom, and it's not there yet, but if we double bottom here, not only do we get to this level, that's target 1, but we double that move, and that's target 2. This could be a, I mean, from 80 to 150, that's a, let's say a $70 move. Tack on another 70 bucks on top of that, we're talking about $220 stock. If I own the shares at 90 and I can hang on to this thing to 220, I'm pretty happy with that, as anybody would be, you know, but it's going to take time. So whatever, that's just some other stuff I'm playing that's not US, right? Nick's long on tech, and that's awesome. I'm looking elsewhere. Like, tech is great, but it's so concentrated that I'm trying to protect the portfolio. I still have some gold, some silver. I have some China stuff. I have some, you know, some value stuff. I've got some energy related stuff, commodity related stuff. So I'm kind of all over the place right now, but that's kind of the point, is reducing some of that correlation, but a lot of future stuff. So yeah. Anyway, well, I feel like I'm with you today with all these random things.
Yeah, I mean, it's good to know. I'm kind of concentrated too, so I mean, it's good to have another perspective on things. I do think you're right about the China trade. You know, it just keeps getting beat up, but yeah, eventually, I think it's ripe for a turnaround. Just because I think China's economy has a lot of potential, but it's hard to back China when you know that their government at any time could step in and you know, a company could go to zero. They could say, no, we're no longer letting this company run a business. So that's the fear in China, because they have the power to shut things down, unlike the US. So there is that, but you know, it's not in their best interest to do so. So I guess the odds of them actually shutting down Baidu or Alibaba's kind of low.
I think it's low. But again, that is a risk associated with it, and I understand that that's a risk I'm willing to take, and that's what those risks I have to take. But I think, again, this is just my opinion here, but I think on the surface everything looks contentious, everything looks adversarial. But I do think that world number one, world number two need each other a lot more than they really let on, right? I mean, we need China as a producer and manufacturer, and they need us as a consumer. And if all of a sudden we stop buying from China, or we, tariff the crap out of everything in China, okay. I mean, there can be tensions and trade wars and what have you, but
like 2018, I remember that.
Right. So I mean, it's like, but I still think that you can't be world number one without having some type of global presence. You can't be world number two without having a global presence. I mean, you could see this, alignment of, okay, all these countries are going to align around China because it's a non-US play, but I don't know how many developed nations are going to align around a communist country, and I'm not saying the US is always going to win out, but all I'm saying is it's an interesting dichotomy, or like a yin and yang. It's like China offers things that we don't have. Ethically, if you think like, oh, their labor costs are so much cheaper because of child labor or things that are ethically wrong and gray. Okay, so we have different standards, right? But this is how their country operates. And if those are margins that multinationals still consider going into and they do business in China, what do they want? They want cheap labor. They want padded profits. They want higher margins. If we know one thing's greedy in this world, it's going to be corporate America. You can drink the ESG Kool-Aid all you want, but stocks that are ESG and all ESG, they're not performing well. I think that stocks perform well right now. It's stocks that make money, stocks that have margins, stocks that have cash. And so, I mean, I've literally seen, historical portfolios on, they call it like the dirty portfolio, which is just your alcohol, your tobacco, your defense and aerospace, your war, like anything that's really dark and seedy. Those stocks actually make a lot of money and have a ton of cash. So it's different stuff. But anyway,
Good points.
different strokes for different folks,
Well, look, Chris, we've been live for 2 hours. I think I'm going to call it for me, unless you want to stay on. But
I'm good. Let me do this. Let me go for another. I'm good for like 9 minutes, dude. You want to hang with me for 9 minutes? I was just going to walk through some technicals for everybody.
Yeah, sure.
All right, you're hanging out for 9 minutes.
Why
right.
not?
Frank's he's gonna rally. All right. All right. US 30. That's the Dow. All right. So let's do a little rapid fire segment here. Let's go through some charts. So Frank, you see some comments, just to throw them out at me. US 30 is essentially the Dow. I think, I like it. I've been disappointed that the Dow's been underperforming, considering this rip to the upside was so good on the Dow, and it's fallen flat. Now I see this is one little bit of optimism that I could have for the market. If we see a broader market, I know that the US 30 is not a broad market, but this is also a fair price weighted index, where if we blow this top off, that is an ascending wedge that I think has, good upside and a broader market rally written on it. The issue is if we don't blow those tops off and we just keep going sideways, this is going to narrow so much into a corner that we've got to have some type of decision. So could it break down? Yes. Could it go higher? Yes. And that's essentially what I'm dealing with right now. I don't know what to do on the Dow outside of stay out of the way, right? So my positions, I've got ratio spreads on the DIA. I've got out of the money puts. I'm just trying to generate income, because if this stays sideways, time works in your favor if you just out of the way, collect some income, and then when it makes a decision, it'll make a decision. But eventually that decision is either a break to the downside, or we blow these tops off and off we go for another rally. But I don't know, and that'd be an interesting rotation if all of a sudden the Dow started to pick up and outperform NASDAQ like it did, on this little stretch. This little stretch here, the Dow is actually performing better than the NASDAQ. The drawdown was more contained than NASDAQ, but NASDAQ is now blown off those highs again, and the Dow has not. So not bad. All right, so that's US 30. Dollar index, I keep getting some requests on dollar index. Swiss pairs, yeah, Lee, you know what I'm doing there, right? I'm just long against everything the Swiss, except for the Swiss yen. DXY, Frank, I've kind of made an executive decision this week in my Forex trading. I don't think we're going to have any clarity on the dollar period. I've noticed that my trading this year on the dollar has been individual currencies, not necessarily baked in on the dollar basket. I think this level, these ranges that I still have, I think there's more clarity on the dollar probably coming out of summer, maybe September, maybe October through November. I'd like to see the dollar do something else. I'm kind of exhausted trading the dollar. I think it won't make up its mind. Individually, I see the Aussie dollar looks pretty bullish. The euro dollar is a bit of a mix. That's your heaviest weighted currency anyway. The pound dollar is, up near highs. The New Zealand dollar, I was almost stopped out, but I'm still like fine on the trade for right now. I'm like down 20 pips. Dollar CAD is on the brink of it's holding support, but if it doesn't hold, like that'll be another ugly trade. Dollar Swiss, I'm long. Dollar yen, you could be long all day, but it's a mix. I mean, it's not an easy trade to say dollar strength, dollar weakness. It's not that simple. So I think that we still keep watching for maybe something like this. Maybe some indecision that's happening on the dollar, and eventually we get a more clear confirmation of one way or the other. Now, what would be the dollar strength reason? We'd have to have a stock market sell-off, in my opinion. Stock market sells off, dollar gets stronger, yen gets stronger, risk-off trading. Dollar gets weaker, market maintains a rally, dollar takes it and takes a punch in the nose, and we have risk on with weaker dollar, and the stock market is the beneficiary from a weaker dollar and a Fed that's cutting rates. So I'd like to see a little bit more clarity. Again, we don't really know until September probably. I would think that the market's trying to price this stuff in, but the Fed is so consistent. Every FOMC meeting minutes, a 2-day testimony, Fed at the end of the month. I mean, we have enough news in the Fed that the market's not quite sure what to do with the dollar, and I'm just not loving it. So there's my dollar stuff. All right. Anything else you're liking, Frank? A couple more minutes.
No, not really. Like I said, I'm not really looking at anything right now. Once I close out at gold, it's hard to justify getting long on the SPY at these highs. So whatever trades I'm in, like I'm just kind of holding them.
Okay.
Yeah, I'm just.
How much
I'm just
ownership do
waiting.
you have, by the way, in your portfolio? How much owned stocks do you have?
I would say so. In my Roth, I don't know the exact number, but I think I've got like 70% in the market right now.
Okay. And then 30% what? Is it 30% unallocated or 30% are you in like a T-bill?
No, so I would say 70% is in the market, and then maybe 10% is sort of a hedge. The rest is cash.
Gotcha. Okay. If that cash is going to stay, you could consider doing this. Depends on the broker, but this is a pretty good instrument to trade. This doesn't fluctuate a lot. This fluctuates, a few percentages here and there, a few cents here and there. But this is essentially a short-term treasury. So your 1 to 3 month T-bill would be the same as let's do US03Y. I don't need 1 to 3 year. So BIL is 3 month. So US03MY, that's month yield. If you had an unallocated position, you're getting treated to roughly a 5+% yield on those on the unallocated cash. So I mean, you're essentially taking cash and putting it into BIL, but every quarter you're getting a distribution on that. Take 5%, split it over the quarter. It's not bad for unallocated cash. If you got 5% quarterly, you're getting a 1.25% return on that per quarter. And again, that's better than just having it sit in cash and do nothing. So that's not a bad way to actually allocate some unallocated cash, and it's super liquid. It doesn't fluctuate a lot. So, I mean, if you're down a couple of cents, doesn't really change much, which is the point. It's essentially just parking cash somewhere, letting it have some yield so it's unallocated, and then you can pull it and apply it when needed. So that's a pretty good spot. Just saying. So,
Yep. Maybe I'll.
All right, dude. You want to get off 7 minutes ago? I'll let you go.
All right. Thank you, Chris. Thank
All
you
right,
for
Frank.
letting me get.
I promise I'll entertain you more. I'll entertain you more later.
No, I'm just sleepy. It's one of those days. But
Gotcha.
Yeah, thanks for hopping on and staying on for this long, and thanks to everyone out there watching. We still got quite a lot of viewers for for the past 2 hours we've been on. So thanks to everyone.
For sure. We should always have a lot of viewers, man. This is good stuff all the time. Whatever segment we are in, whatever guests we have, it's like, this is always good stuff. So as always, thanks for jumping in, and we'll see you later. Thanks, Frank.
Yep. Thanks.
Bye-bye.
See ya.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn.
Are we still going?
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.